Happy Jobs Friday. The U.S. labor market added 151,000 new jobs in January, according to the Labor Department. The unemployment rate fell slightly to 4.9%, hitting an 8-year low, its lowest level since February 2008. Here with analysis is Moneybeat reporter Paul Vigna, who spent the morning crunching the numbers.
Yeah, we
Paul,
sure did.
great to see you. Mixed bag a little bit here, right?
Yeah, mixed bag, I would say tilted towards not quite as good, the downside of the bag, if you want. The headline number, 151,000 jobs, was under expectations and well below what the last 3 months had produced. So definitely taking a step down there. You want to balance it. You want to talk about the unemployment rate. That went down a little bit, but that number's been around there for a long time. And there are a lot of reasons why people just aren't putting a lot of weight on that unemployment rate number anymore. The other sort of counterbalancing thing, if you want to talk about, is wage growth.
Right. We saw a tiny bit of wage growth.
You saw a tiny bit of wage growth. Overall, wages were up about 2.5% from a year ago, which is better than it's been, so that's a good number.
Yes.
But in absolute terms, what you would see in a healthy economy would be a higher number.
And you point out that a lot of these added jobs were in very low-paying sectors.
Yes, and this is where you start to break these numbers down. This is where the report starts to look less good, because the two sectors that produced the most amount of jobs in January were retail trade, which added 58,000 jobs, and leisure and hospitality. Those are the two lowest paying sectors.
Right.
So a lot of jobs coming in low-paying sectors, not particularly good. And retail trade especially, that's a strange one. 58,000 jobs
in January,
in retail, unless they were just crazy post-Christmas sales that Walmart and the dollar stores needed. You know, I don't exactly understand why that number came out so large.
So, Paul, how is the Fed likely to interpret this?
Well, look, the thing of it is, the Fed's next meeting is in the middle of March. They will have one more jobs report before then. So they're going to look at this, they're going to put weight on it, they're going to break it down, but this is not a make or break number for the Fed. They have another month and a half to look at the rest of the data, to look at the economy before they have to make a decision in March. March is the big meeting where everyone is looking. The market has already made a decision. The market already thinks that the Fed will do nothing at the March meeting. They are betting heavily that the Fed won't do anything in March.
Speaking about the market, how is it reacting this morning on the news?
Not so good. You know, they're kind of trying to hold on. They're trying to figure out exactly what it means. But now, as we're talking now, they might pull the numbers up. The Dow's down about 200 points, S&P down about 30 points. If they go much further than here, you're going to start getting back near the January lows when the markets were selling off heavily. If they start getting back to those levels, people are going to start getting nervous again. So the market wasn't in a very good place before this started. This is not helping all that much.
Paul, looking ahead, do you see, though, any bright spots?
Well, I hate to say no, but
you're going to say.
Well, look, I mean, the economy is not careening, okay?
No.
Maybe that's the one bright spot.
Right.
But a lot of economic reports don't look particularly bright. This jobs number, not particularly bright. Corporate profits, we're getting the 4Q earnings reports now. They're not doing very well either. I mean, the best thing you can say about the economy right now is that it is not clearly falling off a cliff. But I have to be honest, I don't see many reasons to think that the economy is going to get much better in 2016.
All right, Paul Vigna, there you have it. Thank you so much.
Yeah, all right, Tanya.